A war headline can reach a retiree's kitchen in less than a week, not through tanks or politics, but through receipts. One day the TV shows Middle East escalation, the next day oil jumps, a few days later gas is suddenly higher, groceries feel heavier, and the safe retirement budget starts to crack. And here is the brutal part. A retiree can lose spending power without losing a single dollar in the market. The portfolio may look fine, yet life gets more expensive fast. How does a conflict thousands of miles away turn into a pay cut in America? And what happens when inflation rises at the exact moment markets wobble? Middle East tension does not stay on a world map. It shows up in American life as a quiet pay cut, not a dramatic one. The kind that slips into the budget line by line until a retiree looks up and realizes the same month now costs more than it did a few weeks ago. Start with the simplest link in the chain, energy. When conflict risk rises near major oil regions or key shipping routes, oil prices can move fast because markets price uncertainty before anything actually runs out. And oil is not just gasoline. Energy is a base cost inside almost everything people buy. When energy costs rise, transportation costs rise. When transportation rises, the cost of food, household goods, building materials, and even parts of the medical supply chain tends to creep upward. This is why a headline can become a receipt. A retiree does not need inflation to explode to feel pain. Even small inflation compounds, and retirees experience it like a tax because they cannot easily replace lost purchasing power with more work. For a household living on a fixed withdrawal plan, a few $100s more each month is not just inconvenience. It is a change in the math. It can force higher withdrawals, and higher withdrawals change risk. Then the next layer hits. Shipping and insurance. When global risk rises, insurers may reprice shipping lanes, and freight costs can jump. Companies pass those costs forward. Consumers see higher prices later, often weeks after the initial headline. That lag is dangerous because it makes retirees think the risk is over. Then the cost surge arrives after they have relaxed. Now add the financial layer. In a risk-off environment, investors often rush toward safe assets. The U.S. dollar can strengthen, gold can spike as a fear signal, bond yields can swing as markets reprice inflation and growth. These moves dominate the news, but they are not the main danger for retirees. They are signals. The real danger is what happens when higher prices collide with market volatility. That collision creates the most damaging retirement condition. Inflation pressure plus shaky markets at the same time. Here is why. If costs rise, retirees withdraw more. If markets fall while withdrawals rise, the portfolio takes damage that is hard to undo. This is sequence of returns risk. The idea that a bad stretch early in retirement can permanently reduce what a portfolio can safely support over decades. It is not about being unlucky for 1 year. It is about being forced to sell more shares when prices are down. Because life got more expensive, that is what makes geopolitics relevant to retirement. It is not about predicting what happens next in the Middle East. It is about understanding that global stress can turn into higher bills, and higher bills can force bad timing decisions. So the real question becomes personal. If the world can raise your cost of living without warning, what kind of retirement plan is built for chaos instead of calm? The first shock of a geopolitical flare-up is rarely a stock chart. It is a normal day that suddenly costs more. A retiree pulls into a gas station and pauses before squeezing the handle. The numbers on the pump climb faster than they did last month. On the way home, they stop at the grocery store and do the quiet math that no one sees. They choose the smaller pack of meat. They skip a brand they used to buy without thinking. They tell themselves it is fine, just being disciplined. But the feeling underneath is different. It is not discipline, it is vulnerability. Because this time the higher prices did not come from their choices. They came from the world. This is why Middle East tension matters even to people who never trade oil, gold, or currencies. Energy is not only a price at the pump. Energy is a cost inside almost everything, from transportation to manufacturing to food storage. When energy rises, the entire economy feels it. And retirees feel it first because they cannot offset it with more earnings. They do not get a raise when their costs rise. They get a silent pay cut. A working family can respond to higher prices by working overtime, switching jobs, or delaying a purchase. A retiree's options are narrower. They can withdraw more from the portfolio. They can cut spending, or they can do both and call it being careful. But both choices carry a hidden cost. Withdraw more and the portfolio must work harder to last. Cut spending and life gets smaller. Often in the years when health and mobility are still good. The worst part is how quickly this happens. Retirement plans are usually built around annual averages. A few percent inflation here, a few percent return there. But real life arrives as monthly surprises. A higher insurance renewal, a higher utility bill, a grocery total that feels wrong. The retiree does not feel like they are following a plan anymore. They feel like they are reacting. And the reaction is often emotional. When a retiree sees the world getting unstable, the brain starts scanning for what could go wrong next. Another spike in prices, a market drop, a recession, a medical bill. The same headlines that push gold higher and the dollar higher also push retirees into caution. They start delaying life again. They cancel trips. They stop replacing things. They turn retirement into a holding pattern. This is the first cause of the trap. A global shock can change daily costs quickly, and that forces behavior changes even when the portfolio has not moved. The retiree does not lose money. They lose confidence. And when confidence breaks, the next decision becomes dangerous. Because the retiree starts looking for one simple answer: buy gold, hold more cash, stop spending. Wait it out. But which of those is protection, and which of those is panic? That question leads to the next chapter. Why oil and shipping matter more than gold headlines. And why understanding the chain reaction is the difference between a resilient plan and an expensive mistake. When geopolitical tension rises, the headlines usually focus on what looks dramatic: gold surging, the US dollar jumping, stock futures swinging overnight. Those are the numbers people screenshot and share. But for retirees, the most important numbers are often less glamorous. Shipping, insurance. Because those are the channels that feed inflation into daily life. Oil is not just gas. It is the price of moving the modern world. Trucks bring food from farms to distribution centers. Planes move high-value goods and medical supplies. Ships carry everything from clothing to electronics to raw materials. When oil rises, logistics costs rise. And when logistics costs rise, companies pass those costs forward across thousands of products. That is how a conflict thousands of miles away turns into a higher grocery bill in America. Shipping costs add a second punch. Even when oil is stable, conflict risk can change the cost of insuring cargo, routing ships, and managing delays. If a shipping lane becomes riskier, freight rates can jump. If ships reroute, travel time increases. If travel time increases, delivery slows. If delivery slows, inventories tighten. And when inventories tighten, prices climb. The retiree does not see shipping insurance premiums. They see cereal that costs more than it did last month. This is why gold is often the wrong focus for everyday retirees. Gold can be a fear thermometer. It tells you stress is rising. But gold does not directly determine what you pay for food, electricity, or medication. Oil and shipping do. The key is not whether gold goes up. The key is whether inflation pressure is about to show up in your budget while you are also exposed to market volatility. Now bring the dollar into the story. A stronger dollar can make some imported goods cheaper, but it can also signal global stress and tighter financial conditions. It can affect corporate profits and market sentiment. In other words, the same environment that can lift the dollar can also shake stock markets, or at least increase uncertainty. That uncertainty matters because retirees do not experience markets the same way as workers. Workers can wait out volatility while they keep earning. Retirees are withdrawing. Volatility becomes personal. This creates a double squeeze that retirees often underestimate. If prices rise, they must withdraw more to maintain the same lifestyle. If markets wobble while withdrawals rise, the retiree is forced to sell more assets at worse prices. That is not a theory, it is how sequence risk destroys plans quietly. The retiree can be right about long-term returns and still get harmed by short-term timing. And here is the hidden behavioral twist. When retirees see gold up and headlines screaming, many feel pressure to do something. They chase the feeling of safety. They move money at the worst time. They change the plan based on emotion rather than structure. They trade a long-term strategy for a short-term relief. So chapter 2 is the clarity chapter. The real threat is not the headline asset. It is the chain reaction into costs, and the timing pressure it creates on withdrawals. Which leads to the most dangerous chapter of all. What happens when inflation rises and markets fall at the same time, early in retirement? That is where the math becomes brutal, and where the wrong reaction can permanently shrink a retirement for decades. In retirement, the same market drop can feel completely different depending on whether money is being taken out. A 45-year-old worker can watch the market fall and tell themselves they will wait it out. They still have income. They can keep buying through the downturn. Time is on their side. A 62-year-old early retiree does not have that luxury. They are not just watching a chart. They are selling pieces of their future to pay today's bills. That is why the most dangerous moment for an early retiree is not simply a bear market. It is a bear market paired with higher living costs. This is the sequence risk trap in plain English. When markets fall early in retirement, withdrawals become heavier relative to the portfolio. If inflation rises at the same time, withdrawals rise further. The retiree sells more shares when prices are down. Those shares are gone forever. When markets recover later, the retiree owns fewer shares.
So the recovery does not rebuild the plan the way it would have if the retiree had not been forced to sell so much.
The damage is structural. It is not about one bad year. It is about the portfolio losing its ability to compound because too much was removed at the worst time. This is exactly why geopolitical inflation shocks matter. A retiree may have planned for a normal world, a steady inflation rate and normal market cycles. But a conflict-driven spike in energy and shipping costs can push inflation higher quickly. That higher inflation forces higher withdrawals. Meanwhile, the same fear environment can increase market volatility. Now the retiree is facing the double squeeze. And the double squeeze creates a brutal psychological test. When prices rise, retirees feel angry because they did not choose this. When markets wobble, they feel scared because the portfolio is their life support. Combine anger and fear, and the brain craves certainty. That is when people make irreversible moves. They sell to cash because it feels safe. They chase gold because it feels solid. They stop rebalancing because they cannot bear the headlines. They cut spending so hard that life becomes joyless. They do not realize that the biggest threat is not today's market. It is the decision they make under stress that locks in permanent damage. A resilient retiree acts differently. They assume volatility will happen. They plan for it. They keep a cash buffer to avoid forced selling. They use guardrails spending so costs can flex without panic. They rebalance with rules, not with feelings. They understand that the goal is not to win the news cycle. The goal is to survive the sequence window without breaking the plan. Because the truth is uncomfortable. Early retirement is not just a math problem. It is a timing problem. And timing is most fragile in the first decade after leaving work. So the question becomes sharp. If the world can trigger inflation and volatility at the same time, what is the difference between a retiree who becomes trapped in fear and a retiree who stays in control? That is the next chapter. The behavioral trap that headlines create, why the most common reactions feel safe but cause the most damage, and how a retiree can build a crisis playbook that prevents regret. When the world feels unstable, retirees do not just manage money, they manage fear, and fear has one demand: do something now. That is why geopolitical shocks are so dangerous to retirement plans. They do not just move prices. They move behavior. They push people toward the exact actions that feel safe in the moment and cost the most over time. The first common reaction is the freeze. Retirees stop spending almost entirely. They cancel travel, avoid family visits, delay medical care, and turn retirement into a tight survival mode. It feels responsible. But the cost is hidden. Life shrinks in the exact years when health and mobility are still available. The portfolio may survive, but the retirement does not. The second reaction is the chase. Retirees chase whatever looks like safety in the headlines. They shift too much money into cash after a drop. They buy gold because it is rising. They abandon a diversified plan because one asset proved itself for a few weeks. The irony is painful. The move that feels like protection is often the move that locks in losses or buys an asset after its fear-driven surge. The third reaction is the story trap. Retirees start building a narrative that explains why the world is permanently broken. They stop believing in any plan. They stop rebalancing because they think the rules of investing changed forever. They keep waiting for certainty that never arrives. Every new headline becomes proof that action is impossible. And the fourth reaction is subtle but deadly. It is the belief that retirement can be postponed until the world calms down. That belief sounds harmless. It is not, because the world does not give retirees a stable decade on request. The calendar keeps moving. Health changes. Family situations change. The years when spending can buy experiences are not infinite. Waiting for perfect stability is like waiting for the ocean to stop moving. A crisis playbook exists for a reason. It turns panic into procedure. A retiree who has a cash buffer does not need to sell investments at the worst moment. A retiree who uses spending guardrails can cut discretionary spending temporarily without cutting the core of life. A retiree with a rebalancing rule can add to what is down and trim what is up without guessing the news. A retiree who understands the chain reaction of oil, shipping, and inflation can respond with targeted adjustments rather than emotional swings. The difference between resilience and regret is often one thing: planning ahead for how the mind behaves under stress. Because the market is not the only thing that can crash, confidence can crash, and once confidence crashes, retirees can destroy their own plan with decisions that felt like survival. That is why this topic matters. It is not about predicting whether conflict expands or cools. It is about protecting retirement from the human reaction to uncertainty. So what happens next? How does this play out over time? What do two retirees with the same 1,000 do in the same headline storm? And why do they end up with completely different lives? Two early retirees can face the same Middle East headline storm with the same 1,000 portfolio and still end up living two complete different retirements. One ends the year feeling bruised but stable. The other ends the year feeling permanently smaller. The difference is not luck, it is the response. Retiree A is 62 and retired early. When the headlines escalate, they do not pretend it is irrelevant. They also do not panic. They pull out a one-page crisis plan they built in calm times. It has 3 rules. Rule 1, protect liquidity. They keep a cash buffer that covers a meaningful slice of expenses. When prices rise, they can increase withdrawals for a few months without selling stocks in the middle of chaos. Rule 2, follow guardrail spending. They cut discretionary spending, but they do it strategically. They pause luxury travel. They delay upgrades, but they keep the core of life intact. They still visit family. They still protect health. They still allow small joys that prevent burnout. They treat the cut as temporary and specific, not as a new identity. Rule 3, rebalance. Do not react if stocks fall and bonds rise. They trim what is up and add to what is down within clear limits. They do not change their long-term strategy based on one news cycle. Now look at retiree B, also 62, also with the same portfolio. When the headlines escalate, they experience it as a threat to their entire future. They watch gold surge and feel behind. They watch the dollar spike and feel like something terrible is coming. They see gas and groceries rise and feel like the plan is failing. They crave certainty, so they take action that feels safe. They move a large chunk of investments into cash after the market drops. They buy gold after it has surged because it proved itself. They stop rebalancing because they cannot bear the volatility. They cut spending in a way that is not strategic, it is emotional. Trips get canceled, family visits get postponed. They delay medical care. They start saying no automatically, because no feels like control. 12 months later, the numbers tell a story. Retiree A has higher expenses for a period, but their portfolio is still positioned to recover because they did not lock in losses. Their lifestyle bent but did not break. Their confidence survived. Retiree B feels safer because they hold more cash, but the cost is silent. They may have locked in a lower portfolio base. They may have bought fear assets late. Even if markets recover, they participate less. More importantly, their retirement identity shifts. They become a person who is waiting for calm. The waiting becomes permanent. That is the personal consequence. Retirement becomes a psychological environment, not just a financial one. A plan can survive mathematically while a person feels destroyed emotionally. There are also broader consequences. The first is inequality of resilience. Not everyone can build buffers. Not everyone has the same health or the same housing situation. When inflation flares, the damage is not evenly shared. A retiree who owns a home outright feels different from a retiree facing rent increases. A retiree with strong health feels different from a retiree with ongoing medical costs. Crisis exposure is unequal, and the same market can deliver very different lived outcomes. The second is the social consequence. Under stress, many retirees pull back from spending and connection. They travel less, they socialize less. They delay spending that supports local businesses. They become cautious at scale. In a large economy, that caution can reduce demand, which can add pressure to the very growth that markets need to recover. Individual fear becomes a collective drag. The third is the global comparison. In countries where retirees rely more heavily on guaranteed income and where health costs are less uncertain, a geopolitical flare-up can still raise prices, but retirees may feel less personal exposure. In the United States, retirees often carry a higher share of market risk and health cost uncertainty at the same time. That combination makes global volatility feel more personal. So the comparison leads to one conclusion. A crisis does not just test portfolios, it tests systems and behavior. It rewards people who planned for chaos. It punishes people who expected calm. The next section is the relief section. A practical framework that turns this from a scary headline story into a retirement strategy. A crisis playbook that helps retirees protect purchasing power, avoid bad timing, and keep their life from shrinking while the world is unstable. A geopolitical shock does not require a retiree to predict the future. It requires the retiree to manage exposure. The goal is not to guess what happens next in the Middle East. The goal is to keep purchasing power and decision-making intact while prices and markets swing. A practical chaos-proof retirement framework can be built in 6 moves. Move 1 is to separate essentials from everything else, and treat inflation as a first-class risk. Essentials are not optional. Food, housing, utilities, insurance, transportation, basic health costs. When inflation flares, essentials are the first place the pressure shows up. The plan should model what happens if essentials rise faster than expected for a year or two. That does not require perfect forecasts. It requires acknowledging that spikes happen. Move 2 is to build an emergency cash buffer designed for withdrawals. Not fear. This is not about hoarding cash forever. It is about avoiding forced selling during volatility. A buffer that covers a meaningful slice of expenses gives a retiree time. Time is what prevents panic decisions. Without time, retirees sell at the worst moment. With time they can wait, rebalance, and let markets do what markets eventually do. Move 3 is to adopt spending guardrails, not a rigid annual rule. In a volatile world, fixed spending rules break.
Guardrails work because they adapt. The household sets a base spending level that covers essentials and a life layer for travel,
upgrades, and discretionary goals. The life layer expands when the portfolio is healthy and contracts when it is stressed. This turns cutting back into a planned move, not a personal failure. It preserves dignity and reduces the risk of the under-living spiral.
Move 4 is to automate rebalancing rules so the retiree does not have to think during chaos. A simple principle can carry a household through headlines. Trim what is up, add to what is down, within limits. Rebalancing is the opposite of panic. It forces discipline when emotions are screaming. It also reduces the temptation to chase gold or flee to cash after the market already moved. Move 5 is to treat Social Security and guaranteed income as a stability tool, not just a maximizing game. In a world where inflation and volatility can arrive together, guaranteed income reduces portfolio dependency. That does not mean everyone should claim early or everyone should delay. It means the claiming decision should be tied to the household's risk profile. If a retiree needs more stable cash flow to avoid panic withdrawals, claiming earlier can be rational. If longevity risk is high and the portfolio is strong, delaying can still make sense. The key is that Social Security should be used to reduce sequence risk, not to win a bigger check while life gets squeezed. Move 6 is to create a 30-day crisis plan that prevents expensive reactions. This is the playbook retirees follow when headlines surge. It includes 3 steps: pause major portfolio changes, review essentials spending and adjust the life layer, not the core, rebalance on schedule, not on emotion. The plan does not try to be heroic, it tries to be consistent. Looking forward, geopolitics will likely remain a recurring source of inflation and volatility shocks. Energy markets can shift fast, supply chains can reprice risk, the dollar can swing with global fear. That means retirement planning cannot be built only for average years. It has to be built for stress years. Because the most important retirement asset is not gold, not the dollar, and not even the portfolio balance on a statement. The most important asset is flexibility. Flexibility is what lets a retiree absorb shocks without selling low, without shrinking life permanently, and without turning every headline into a personal emergency. A geopolitical crisis does not need to destroy the stock market to hurt a retiree. It only needs to raise the cost of living fast enough to change behavior. That is the quiet danger hiding behind Middle East headlines, gold surges and dollar swings. The real damage is not always on a chart. It is in the moment a retiree starts living smaller because the world feels unstable. This is what the story has shown. Oil and shipping are not abstract, they are inflation channels. Inflation is not just a number. It is a pay cut for anyone living on withdrawals. And when inflation pressure collides with market volatility, the risk becomes structural: sequence risk, forced selling, panic decisions. The portfolio can survive mathematically, while the retiree loses confidence and loses years. But the future does not belong to fear. A resilient retirement plan does not require perfect predictions, it requires a playbook, cash buffers that buy time, guardrails, spending that protects dignity, rebalancing rules that prevent emotional mistakes, and a claiming and withdrawal strategy designed for stability, not for bragging rights. Because retirement is not a reward for winning a spreadsheet, it is a season of life. The goal is not to be untouched by chaos. The goal is to stay in control while chaos happens. If this video helped you connect the headlines to your real retirement risk, subscribe for more deep, data-driven retirement analysis built for the real world, not the perfect world. And share your situation in the comments. When you see gold and the dollar moving, what is the first thing you feel? And what decision do you worry you might make under pressure?